All right, gather around for this one, because today we're tackling a topic that is quietly ending more prop firm trading careers than bad market conditions, faulty indicators, or sudden news events combined. Welcome to The Explainer. Now, I want to set the scene for you right off the bat and talk about a very specific tragedy. It's not a dramatic market crash, no. It's the silent, mathematical trap of the daily loss limit. You see, the vast majority of failed prop firm challenges, they don't actually happen because a trader suddenly forgot how to trade, or because they had a terrible strategy. No, they happen because of tracking failures. Literally, they happen because of math.
Let me tell you a story about a Tuesday. We'll call our guy the Tuesday trader. So he wakes up, he's feeling absolutely great, pours his morning coffee, and fires up his FTMO challenge account. And he's been doing fantastic, right? He's up $4,200 in phase one, riding this massive wave of confidence, and he's almost halfway to that magical 10K target. So he takes a trade on gold, he loses $1,100. Fine, whatever, that happens. It's just part of the game. He takes another trade, loses $900. Okay, a bit annoying, sure, but he's still well in the green overall. Then he takes a third trade, slightly larger this time, kind of trying to aggressively recover some of that morning momentum. He loses $1,600. Now, the frustration really sets in. The heart rate goes up. He takes a fourth trade, loses $1,500. And then his screen freezes. The account is immediately closed. It's over, done. He lost exactly $5,100 that day. And his daily limit? Well, it was $5,000.
$100 overage. Think about that. Just $100 over a $5,000 limit, and his entire challenge was ripped away on a day where, get this, he was technically still in overall profit for the challenge. Seriously, he was still up overall, but he lost the whole thing. So why did this happen? It wasn't some catastrophic reckless blowout. It was simply because he didn't know exactly how close he was to the cliff's edge. He wasn't tracking it in real time. He was doing what so many of us do. He was running the numbers roughly in his head, he was just estimating his drawdown, and he got it slightly wrong. That tiny $100 miscalculation, a simple mental math error, completely ruined his challenge. The psychology here is both fascinating and honestly devastating, and it's exactly why mental math has absolutely no place in professional trading.
Okay, let's dive into this and deconstruct the math. There are three main calculation methods.
To stop this absolute nightmare scenario from happening to you, we have to methodically break down how these prop firms actually calculate their daily limits, because it's not a universal standard, and assuming it is, that's going to get you into serious trouble. There are three main methods you need to know. Let's start with the baseline. Method 1 is the absolute easiest. It's fixed right from your starting balance. If your starting balance is $100,000 and the daily limit is 5%, your limit is $5,000 every single day. Day 1, day 15, it doesn't matter if your account has grown to $108,000 or dropped to $94,000, the limit is a rock-solid $5,000. Firms like Funded Next use this one. It's incredibly simple. You write it down once, you memorize it, and you're good to go. Then we have method 2, which is where things start to get dynamic. It's recalculated daily from your current balance. This means your daily limit updates every single day based on your exact equity at the start of that specific trading day. Start day 8 with $103,000, your limit is 5% of that, which gives you $5,150 to work with. But start day 12 with $97,000, your limit drops to $4,850. It scales with you, moving up and down, but it requires you to actively recalculate that boundary every single morning before you even think about clicking a button.
And that brings us to the FTMO hybrid trap, the ultimate method 3 danger zone.
Now lean in close for this, because this specific calculation method catches the absolute most traders completely off guard. It ends challenges faster than you can even blink. We are talking about method 3, which I like to call the FTMO hybrid trap, because FTMO's logic works entirely against your intuition when you're winning. They calculate the daily limit as 5% of whichever is lower, your starting balance or your current balance today. So let's say you started with $100,000. You've had a really great run, you've traded beautifully, and you've grown the account to $107,000. You wake up feeling invincible. What's your daily limit today? If you guessed $5,350 because it's 5% of that $107K, you'd be wrong. FTMO takes the lower of the two numbers. The lower number is your starting $100,000. 5% of $100,000 is $5,000. So your limit is rigidly capped at $5,000. Your hard-earned $7,000 in profit added absolutely zero room to your daily loss limit for that day.
But wait, what happens when you're on a losing streak? Let's say you've had a rough week, your setups just aren't working, and your account is sitting at $96,000. What is your daily limit now? Again, FTMO takes the lower of the starting balance, the 100K, or the current balance, the 96K. The lower one is obviously 96,000. 5% of 96,000 is 4,800. So your limit actively shrinks down to $4,800. It's now less than your original 5K buffer. The firm's logic here is to prevent one bad day from eating all your remaining challenge buffer when you are already in a drawdown. But for you, the trader, it means the floor is constantly shifting beneath your feet, depending on your current balance. You are literally navigating a maze where the walls move every time you take a hit.
Understanding exactly how this traps a profitable trader is absolutely crucial. Imagine a trader who is up $7,000. They feel incredibly comfortable. They automatically assume their daily limit is 5% of their current $107,000 balance, which would be $5,350. They think they have $5,350 of daily breathing room to play with, but as we just decoded, they only have $5,000. Now let's say this trader is having a moderately bad day. The market is super choppy. They are down $4,700 for the session. In their head, they subtract that $4,700 from their assumed $5,350 limit, and they confidently think to themselves, hey, I have $650 left. That's plenty of room for one more trade to turn this day around. They feel safe. They feel totally in control. But in reality, their true limit is $5,000. They actually only have $300 left. So they take one more completely normal, heavily calculated trade. It goes against them. They lose $400 and boom, account breached. Not because of reckless trading, not because they abandoned their strategy, but strictly because they used the wrong mathematical formula.
Now, moving on to the awakening, the hidden killers. If the calculation method wasn't tricky enough, there is an entirely silent layer to this whole puzzle. Let's talk about the hidden killers. Because your daily loss is not just a tally of your stopped-out trades. There are silent equity drains that are viciously eating away at your precious daily limit before a stop loss is even triggered on your charts. It includes absolutely everything that reduces your account equity. Take spreads, for example. On a 5-lot Euro-US dollar position with a standard 1.2 pip spread, you are paying $60 in spread the very microsecond you click buy or sell. That $60 is instantly, undeniably added to your daily loss. Then there are commissions. If your broker charges $7 per lot per side, that same 5-lot trade costs you $70 in round-trip commissions. Add that to the daily loss tracker. And swaps. If you held a position overnight, that swap fee posts during the next session. For that same 5-lot trade, that might be another $25 to $30. Individually, sure, these seem small. But if you take 4 trades today, each with $130 in these hidden costs, you have instantly consumed $520 of your daily limit before a single trade has actually lost you a penny in the market. This is exactly why looking at your trade P&L column is a fatal error when you're managing your daily limit. It's a massive trap so many folks fall into. If you ignore those operational costs and only track the P&L of your closed trades, your math is going to be wildly inaccurate right from the moment you start your session. The only absolute truth on your trading platform is your account equity. Equity reflects all costs, all spreads, all swaps, and all floating losses automatically in real time. Starting equity minus your current equity gives you your total true daily loss. Do yourself a favor, ignore the P&L column, worship the equity number. It is literally the only metric that dictates whether you survive the day.
So what do we do about this? Let's move to the resolution and see how this builds into the 3-number system.
We've clearly established that mental math is a complete trap. The calculation methods are intentionally tricky, and hidden costs are silently draining your limits. So, the foolproof antidote to all of this chaos is what I call the 3-number system. I honestly demand you do this every single morning. Before you even think about opening a single chart, get a physical piece of paper and draw 3 boxes. Not a digital note on your screen, not in your head. A physical piece of paper right next to your mouse where you absolutely cannot ignore it. Box 1, today's starting equity. What is your exact balance right now? Box 2, your daily limit. Calculate this using your specific firm's exact method, whether it's fixed, recalculating, or that FTMO hybrid we just discussed. And box 3, current daily loss. This one starts at 0. Now here's the real magic. After every single trade closes, you take 10 seconds to update box 3. Lost 800, box 3 is now crossed out and reads 800. Next trade wins 600, box 3 drops to 200. Next trade loses 1,200, box 3 is up to 1,400. You are actively, physically tracking the exact difference between your starting equity and current equity. 10 seconds a trade. That's literally all it takes to anchor yourself in reality and save your account.
Now let's talk about the safety net, the 80% buffer rule.
To make this physical tracking system genuinely bulletproof, we need a psychological and mathematical safety net. And this concept is exactly what separates the amateurs who blow accounts from the seasoned professionals who actually secure payouts. You never, ever trade right up to your 100% daily limit. Never. You trade until you hit 80% of your daily limit. If your limit is $5,000, your internal hard stop limit is $4,000. The very moment your box 3 hits $4,000, your session is over. You close the laptop, you step away from the desk. Why? Because that 20% buffer absorbs absolutely everything. It perfectly absorbs delayed transaction costs, it absorbs any tiny arithmetic errors you might have accidentally made in the heat of the moment, and most importantly, psychologically, it removes that immense, suffocating pressure. Think about it. Trading at $4,850 of a $5,000 limit, that feels like walking a tightrope over a volcano. One tiny slip and you're dead. But trading at $3,600 with a $4,000 internal stop, that feels entirely in control. You have a cushion. You have absolute peace of mind.
I want you to really listen to this profound truth. The traders who pass challenges aren't the ones with the best strategies. Often they're just the ones who track their numbers. It's profound because it is the absolute reality of this industry. If you don't have a paper tracking sheet sitting next to your monitor right now, make one tonight. Just do it for 10 consecutive trading sessions. It'll become an automatic, mundane, maybe even a boring habit, but I promise you, it will be the most profitable habit you ever build. Ask yourself right now, are you actually losing to the markets, or are you just losing to a calculator? Stop letting math rob you of your trading success. If you want the complete system I use, including templates and calculators, check out the Funded Trader Blueprint linked in description.